For the next 30 seconds, Burger King will conduct a test of your appetite alert system.
Burger King is the second largest fast food giant in the United States. The globally famous chain operates 18,000 restaurants in over 60 countries. And with a value of over $7 billion, it is among the most valuable quick-service brands in the world. Never afraid to ruffle some feathers, its ads are characterized by a provocative tone of voice and tongue-in-cheek humor. And its history is just as interesting. From nasty burger wars to moldy Whoppers, Burger King has seen its fair share of unusual events. Curious to find out about how the brand came to be and what it is today? Then make sure to keep watching. And if you've ever wondered what a leveraged buyout is, today you'll find that out too. The predecessor to what is now the Burger King chain was founded in 1953 in Jacksonville, in Florida. It was called Burger King, and Keith Kramer and Matthew Burns were the proud owners. Inspired by the McDonald's brothers' original store in California, the two men had been searching for a concept that was just as fast, convenient, and good. They were impressed by McDonald's speed and automation, and they wanted to offer something similar. After acquiring the rights to a couple of so-called Insta machines, they were ready to get going. The Insta machines were designed to make fast food real fast. There was the milkshake maker that could make multiple milkshakes at once, and the Insta broiler that could cook 12 burgers simultaneously. With it, 400 burgers could be cooked in under an hour. Keith and Matthew saw their chance. They bought the devices, named their restaurant after the quick cooker, and opened their doors. While the Burger King chain slowly began growing, two friends were looking for an opportunity to open their own businesses. Their names were David Edgerton and James McLamore, and they were both alumni of the Cornell University School of Hotel Administration. During this same time in college, James had visited the original McDonald's hamburger stand in San Bernardino, California. He sensed potential in their innovative assembly line-based production system, and he wanted something similar. But instead of opening up a McDonald's franchise, he went for Burger King. In 1954, David and James acquired a license to operate, and they opened their first location at 3090 Northwest 36th Street in Miami. Together, they soon formed the Burger King Corporation. Their goal? To attract the post-war baby boom families with reasonably priced broiled burgers served quickly. The concept was simple, but the idea was not unique. In the early 1950s, drive-ins offering cheap fast food were springing up all across the country. Knowing they needed something to set them apart from their competitors, David and James decided to give their place a special edge. And so their fast food restaurant became the first to offer dining rooms. While they were uncomfortable plastic ones, but still, it was something new. With the Burger King Corporation, the duo kept expanding their business and they opened several other stores. At a time when its competitors McDonald's were still selling only small hamburgers, David and James added the Whopper burger to their menu. It was a bigger burger with sauce, cheese, lettuce, pickles, and tomato, and it was catered to those with big appetites. The special burger brought more customers into their business, but despite the many ingredients, prices were kept relatively low. A regular hamburger cost 18 cents and the Whopper 37 cents. In 1958, the entrepreneurial duo took advantage of an increasingly popular medium to broadcast their services, television. And that year, the very first Burger King commercial appeared on TV. At this same time, David had grown increasingly more frustrated with the issue-prone Insta machines. The original founders, Keith and Matthew, had been so happy with the Insta broiler that they had required all of their franchisees to carry the device. But after noticing that its heating elements quickly degraded from the drippings of the beef patties, David decided something had to be done. To avoid the annoying problem, he created a mechanized gas grill that cooked the meat patties in a different way. He called it the flame broiler. It moved the patties over the flame vertically on a chain-link conveyor, and the design imparted grill lines on the patties which looked like those made on a charcoal grill. The new cooking appliance worked so well that they immediately replaced all of their Insta broilers with newly designed units. And soon enough, the flame broiler's grill lines would become the chain's signature style. By 1959, the pair had several stores within the Miami-Dade area, and operations were growing at a fast rate. However, they were still not the real owners of Burger King. And although the chain could now be found throughout the state of Florida, the group eventually ran into financial difficulties. After the original Burger King began to falter in 1959, David and James decided to step in. They bought out the original founders and immediately initiated a massive corporate restructuring. The first step, dropping the Insta and renaming it Burger King. Feeling ready to expand beyond Florida, the duo felt franchising would be their best bet. In the late 1950s, franchising was booming. From KFC to McDonald's, everyone was doing it. It let companies grow with minimal investment, and it was the best way to take one's concept to a broader market. The system worked well, and it allowed Burger King to grow rapidly. But leaving their franchisees pretty much on their own would be a decision the duo would not soon forget. By 1961, Burger King and its special Whopper were well known in the United States. For a couple of years, the company kept expanding. But once McDonald's went public in 1965, organic growth became difficult to keep up. And after running the company as an independent entity for 8 years, David and James sold their business to prepared foods giant Pillsbury in 1967. By then, it already had 274 stores, and it was worth a whopping $18 million. While David left right after, James continued serving as Burger King CEO until 1972. But once he noticed Pillsbury was taking the business in an entirely different direction, he eventually also stepped down. For the next decade, Pillsbury made several restructuring attempts, and Burger King's shoddy franchising system was one of the main focus points. It had been lucrative, both for the company itself and its franchisees, but it failed in providing a consistent company image. Because David and James had never bothered to check in on their franchisees, the inconsistency in food and service had become a widespread issue. And it seemed like every franchisee was a little bit different. For a company that aims to attract customers by assuring them of what they can expect, this was of course a major flaw. And after several decades of a laissez-faire attitude, it was now up to Pillsbury to crack down on franchise owners and reestablish a sense of consistency. The most prominent change came when Burger King brought in Donald Smith, a hard-hitting executive from McDonald's. With him, Burger King finally began exerting real control over its franchisees. Donald had been third in line for the top spot at McDonald's when Pillsbury lured him away. They promised him full autonomy in the top position at Burger King, and once hired, Donald immediately got to work. To help revamp the company, he began to McDonaldize Burger King. You see, while Burger King had grown by selling wide territorial rights, McDonald's had taken a different approach from the very beginning. They leased stores to franchisees and demanded a high degree of uniformity in return. When Donald noticed that Burger King only owned 34% of the land and buildings in which its products were sold, he knew something had to be done. Land ownership is advantageous because land is an appreciating asset and a source of tax deductions, but more importantly, it gives a company a lot of power over its franchisees. In a plan called Operation Phoenix, Donald initiated a thorough restructuring at all levels of the company. He introduced a more demanding franchise agreement, broadened the menu, and created new store designs to standardize the company's look and feel. It was a process that was especially felt among the franchisees, but the changes were very effective. And during these years, Burger King became the second largest burger chain store in the U.S. after McDonald's. Things were looking great, but then Donald left Burger King for PepsiCo, and Pillsbury appointed Norman Brinker. During his tenure, the infamous Burger Wars began. Norman set up a negative advertising campaign in which he attacked McDonald's and the size of its small burgers. Soon, other burger restaurants joined in on the feud, but the aggressive ad campaign would not turn out to be very lucrative for Burger King. The constant spending on advertising began to affect it negatively, and in 1987, it had to lay off more than 100 people from its corporate headquarters in Florida. Furthermore, over time, the changes Donald had installed were discarded as well, and Burger King fell into a fiscal slump that damaged its financial performance immensely. Would they ever manage to recover? Poor operating performance and ineffectual leadership bogged the company down for many years. British conglomerate Grand Metropolitan acquired Pillsbury in 1989. In the following years, Burger King pretty much stagnated, especially after Grand Metropolitan merged with Guinness and became Diageo. Now, the parent company's focus was on its drinks and spirits business, not on Burger King. Diageo's institutional neglect damaged Burger King to the point where major franchisees were driven out of the business. Its total value was significantly decreased and things were looking dire. To rid itself of the loss-making burger chain, Diageo put the company up for sale in 2000. A consortium of private equity financiers, consisting of the Texas Pacific Group, Bain Capital, and Goldman Sachs, were interested in buying it up. The price tag? $1.5 billion. The group immediately revitalized the company, culminating with it being taken public in 2006 with a highly successful initial public offering, in which they generated $425 million. But despite the successes, the following global financial crisis drastically weakened Burger King's financial outlooks, while those of McDonald's just kept growing. Burger King's falling value led to its owners once again ridding themselves of the chain. This time, 3G Capital took over, and all it had to do was pay a whopping $3.26 billion. 3G Capital is an investment group controlled by the Brazilian billionaire Jorge Paulo Lemann, and it took over Burger King in a leveraged buyout. A leveraged buyout, or LBO, is an acquisition strategy whereby a company is purchased by another with borrowed money such as bonds or loans. Evidence shows that many LBOs result in significant improvements, but there are also some downsides and ethical questions. The usual subsequent increase in cash flow and return on investment is due to a combination of factors, such as tax benefits, strength in management, internal reorganization, and change in corporate culture. On the other hand, LBOs can also cause disruptions and economic hardship in the purchased company. LBOs also raise several ethical questions, notably about conflicts of interest between managers, acquirers, and shareholders, as well as other issues like insider trading and squeeze-outs of minority shareholders. Would this turn out to be the case here as well? When 3G took over Burger King, it knew it would have to invest heavily to reverse the chain's fortunes and to finally close the gap with McDonald's. Burger King stock was temporarily removed from the New York Stock Exchange. They hoped this would help the company repair itself without having to worry about pleasing shareholders, and the decision seemed to pay off. After a series of changes to its operations and structure, Burger King was being sold to the public again by 2012. 2 years later, it merged with the Canadian-based donut and coffee chain Tim Hortons, and a new parent company called Restaurant Brands International was formed. Things were looking better, and Burger King finally had the funds to begin focusing on the creative commercials that it has become so famous for. Not much later, Fernando Machado became the brand's chief marketing officer. Today, Fernando is seen as one of the world's most influential marketers, and during his 7-year reign, he produced some of Burger King's most talked about ad campaigns. The most successful ones all had a couple of things in common. They were creative, memorable, and highly risky. Many of you probably remember the unconventional moldy Whoppers, for example. The campaign featured an up-close look at a Whopper that had been rotting for 34 days. With it, Fernando wanted to show the beauty of real food without preservatives. Although it wasn't the most aesthetically pleasing ad, their courage paid off and it was a massive success. Fernando always aims to drive business growth by pushing creative boundaries. He once said that creativity has the power to bend reality. And according to him, Burger King's secret sauce for success is its combination of self-deprecating humor, its outside-of-the-box thinking, and its company culture that doesn't shy away from failure. "Our main goal is to bring smiles to people," he said. Today, Burger King is doing well. While Fernando Machado stepped down as CMO earlier in 2021, he made sure to leave one final stamp. And Burger King kicked off the year with a fresh new look and a new restaurant concept. The changes marked its first rebrand in more than 20 years. The revamped eatery now has digital menus, self-ordering kiosks, and barstool seating. And the updated aesthetic includes changes to the brand's iconic logo, as well as its menu, social media assets, and employee uniforms. The visuals are now bolder and harken back to retro designs of the 70s and 80s. The changes look promising, but of course, only the future will tell how the brand will do. This was the story of Burger King. Over the years, the fast food giant underwent many changes of ownership and corporate governance. And after nearly a decade and a half of stagnation, it was finally revitalized in the mid-90s with a back-to-basics, value-oriented approach. Although the burger chain has persistently lagged behind McDonald's in sales and profitability, it is still going strong today. In 2020, it generated approximately $1.6 billion in revenue, and despite its intense competition, it has created a strong brand position thanks to its clever growth strategies and memorable marketing campaigns. What did you learn from this video? Share it in the comments. And don't forget to check out our channel for more inspiring business stories.